So over the past few months, we've been making videos and discussing the yield curve, something that I watch very closely every day. In fact, it's the first thing I watch when I get up in the morning. It's a bit of a geeky thing to do, but it is important. But what I wanted to do in this video, real quick, is kind of demystify, um, you know, what the yield curve is trying to tell us. And I think a lot of people are right now trying to confuse that with some sort of immediate reaction that we're going to see in the market because of the yield curve inversion, and it's really not. I mean, we're going to show the charts and look at the yield curve in a minute, but basically, what we're seeing is the way you look at the yield curve is really it's more like an oil tanker. It's the big thing that's ultimately going to give us some direction, and right now it's essentially telling us the probability of a recession going forward is increasing. Not that it's 100% certain or that it's 100% not happening, but the probabilities are increasing. But again, that's a slower moving train or oil tanker. And so a lot of people I think right now are looking at that, and I'll show you the chart in a second, and are saying, well, I should do this and this and this from a trading perspective, and it's really not that. So let's have a look at this real quick. And what I like to do is I like to track the yield curve as it is right now, which is the orange line, versus how it was at some point in the future, usually about a quarter back or so 3 months. And that's exactly what I have here. I have the yield curve as it stood at the end of December 2021. I'm probably going to adjust that to the end of January here in just a few days. And where it is right now, again, it's the orange line. You can see the the um, the orange line it has now basically a downward sloping line from that point to this point here and a couple points within there, whereas at the end of December of last year it was still very much upward sloping. And so basically, in very simple terms, what that means is that people are starting to find some more relative attractiveness um, in bond yields sort of on the 10-year part of the curve than where they are over the next couple of years. Another way of looking at this is that the probabilities of an economic slowdown and probably also some sort of a cap on inflation, uh, inflation at least marginally coming down over the next few years going out, is coming down. So again, note that I'm talking about years here. What this is not telling us is that we should make some movement or something from a trading perspective. So we have to be able to differentiate time frames. And that's really all I want to just touch on is just make sure people understand that looking at the yield curve is not something that should cause you to make a swing trade for 2 days. That's really not what it is. So again, we're looking at a macroeconomic indicator that has multiple years of sort of, uh, forecastability, I guess, or not. That's not the wrong term, but like it should be looked at as a global macro indicator, not as a trading indicator like a moving average or as some sort of in immediate term oversold or overbought kind of thing. It's really not that, but it does give us some broader economic implications and ultimately or guidance, and ultimately really the way we're using it right now is to make sure that from an asset allocation perspective, we are starting to see better reward to risk happening in bond prices, particularly on the 10-year part of the curve, where we think buying bonds out there or an ETF or even futures from a multi-month, at least maybe multi-quarter perspective, is starting to make a lot more sense. So again, the main takeaway, just to keep it simple, yield curve important, yes, but it also doesn't mean that you need to make a trading bet on that right away. It's not a swing trading mechanism. It tells you something about the probability of a recession taking place at some point in the future. And by the way, yield curves invert and go back to normal all the time. It's just that this one now has been a flattening of the yield curve for many months that now finally has some sort of inversion. So the inversion point in time isn't that important. We've seen this happening now for a few months. So again, make sure you use it as a macro indicator, not a trading indicator in the immediate term. Hope it helps. See you again soon.